Do you want to know the 4 steps to becoming a profitable price action trader? If your answer is yes, press that subscribe button and the notifications bell so that you don't miss any of my future videos coming up. Guys, the winning trade that you see on the chart here is based on my prediction that I made last week, and I have a clip of that prediction that I will show you shortly. And I've used the 4 steps that I'm going to share with you on this trade here, and the full video of this prediction that I made last week is in the description. The dollar Canadian is also in an uptrend. In this case, I'm looking for trend continuation trade because this trade here bounced off from this level of structure here and retraced back and made a higher high, which is above the previous level of structure. So what happened here, it came back again to this level here of support. So what I will do here next week, I'll drop down to my 4-hour time frame and look for the entry reason for me to continue in an uptrend. The first step to becoming a profitable price action trader is to go to a higher time frame, then identify your key levels of structure, and then after that you determine your directional buyers. Let's go to a higher time frame. In this case, it's a daily time frame. These are my key levels of structure that I identified last week. We have this swing low here, which is the support, and if you look left here, this level has been tested multiple times, at least support here, small resistance here. Another key level of structure here is this support level, which is being tested at least twice, being tested here and being tested here. And the next key level of structure was at the resistance level here at the swing high. So after identifying your key levels of structure, you have to determine your directional buyers, which means to determine whether the market is in a downtrend or in an uptrend. And how do you determine that? There are so many ways of determining whether the market is in a downtrend or an uptrend. You can use indicators like the exponential moving average, and if the market is above the EMA, then you are in an uptrend, and if the market is below the EMA, you're in a downtrend. But that has a lot of subjectivity. What I use is purely price action. Let's say the market is in an uptrend with an impulsive leg, then retraces. Once the market has made this pullback, I draw my horizontal line at the resistance level here, and if this market breaks and closes above this resistance level here, this is a clear indication of me that this market is likely to continue in an uptrend as long as it does not break and close below this support level. So if this market pulls back to this resistance level or to this support level here and doesn't break and close below this support level, I expect this market to at least continue and touch the previous level of structure, or possibly continue to the upside. An example of a downtrend is when you have a market making an impulsive leg, then pulls back. I draw my horizontal line at the support level, and if this market breaks and closes below this support level here, I draw another horizontal line at the resistance level and wait for this market to either pull back to this support level or pulls back to the resistance level or around this area. Then I expect this market to at least come back to the previous structure or continue to the downside before it goes back to the upside. So this is the simple way I use to determine the direction of the market. When it came to this level of structure, it made an impulsive leg, then pulls back to this level, and what I did was to bring my horizontal line here and wait for this market. If it closes above this resistance level, I would wait for this market to either retest this resistance level or come all the way down here to the previous support level here, but doesn't break and close below this level of the structure. And I expected this market to go up all the way to at least touch this level of structure, or goes back up to this resistance level here. So that's step number one. You go to a higher time frame, draw your key levels of structure, and you determine whether the market is in an uptrend or a downtrend. Step number two is to go to a lower time frame and wait for the market to test the structure and bounce off there. So what you do, you go to a lower time frame, which is 4-hour time frame, and in this 4-hour time frame you have your key level of structure being drawn already. The support level here is being drawn already, and this market came back to this level here. So in this case, I was looking for the buy opportunities. That takes me to the third step, where you look for the confirmation for your entry reason. And the confirmation that I got here was a double bottom. This market came here, retraces back here, and came back again to this level here. So this was my confirmation, and my entry reason was this engulfing candle here. So the double bottom with this engulfing candle here was my entry reason that made me to buy this market. The fourth step is to determine your take profit and your stop loss. Now, why is this take profit and stop loss so significant? It's because when you enter a trade, you don't know whether you're going to win that trade or you're going to lose that trade. But when you lose that trade, you don't want to lose the whole of the capital in your account. You need to lose a portion of the capital in your account. And your stop loss could be like 1 ATR below your swing low. Swing low of the candle is here, so it could be 1 ATR below this swing low. And your take profit could be your previous level of structure, or it could be like 1-to-1 risk to reward or 1-to-2 risk to reward, or anything that is profitable and you've proven that it's profitable in your back testing. If you go and blindly trade this strategy, you're going to lose money, because first of all, you don't have the discipline, you don't have the confidence that this strategy actually works. What I advise you to do is to backtest this strategy on the historical data. Let me make a recap of these 4 steps. So the first step is to go to a higher time frame, like the daily time frame, and draw your key levels of structure. Once you've drawn your key levels of structure, you have to determine whether the market is in a downtrend or an uptrend. And how do you know that? Well, the market is making an impulsive leg and then pulls back here, then you wait for the market to break and close above the resistance level here. And when the market breaks and closes above that resistance level, you wait for the market to retest either the resistance or the support or the previous support level here, and make sure it doesn't close below the support level. And then go to a lower time frame, like 4-hour time frame, then wait for the market to retest this level of structure, the support level here. The step number 3 is look for your confirmation. The confirmation could be any simple price action pattern, like the double bottom, like the one I just got here, and take your trade based on your confirmation here. Now the final and fourth step is to know where to take your profits and where to exit the trade when your prediction is wrong. So if you like this video, don't forget to give it a thumbs up and subscribe, guys. This will help me in the YouTube algorithm, and hit that notification bell so that you'll be notified whenever I upload new videos. Thank you guys for watching this video, and see you next week in the next video.